Inflation is still raging, the yield curve is still inverted, and recession is still looming. So why are stocks headed higher? Plus, I go dumpster diving for some new speculative plays for my speculation in play portfolio. All this and more in this week's episode of the Stock Market Outlook. Why did stocks keep rallying higher this week? Well, it turns out the consensus is that stocks should be headed lower, and typically the stock market likes to do the opposite of what the majority of the people think. In addition to that, there wasn't a whole lot of news this week, so there wasn't a lot to move the markets. And when one of the Federal Reserve presidents, Bostic, came out with what sounded like dovish comments, even though they weren't, the market continued rallying higher. However, I like to listen to a lot of different analysts, and my favorite this week was Elizabeth Young, who's head of investment strategy at SoFi Technologies. She said, imagine what the headlines are going to be on news websites a year from now. The Federal Reserve has raised rates faster than it ever has since the 1980s, and everything came out okay and the stock market wasn't hurt and the labor market was fine. Does that sound like the most likely outcome to you? Me neither, and that's why I'm still bearish about where the stock market's going. For newer viewers, I'm a long-term investor, so I don't allow my personal perspective to really affect what I'm going to do when it comes to my portfolios. I'm always long. However, when I do get more bearish, I'll start taking profits a little bit more aggressively than I might have if I was feeling bullish, and that's about the change in it. As always, it's important to have a plan for both directions. What are you going to do if stocks go up tomorrow, and what are you going to do if stocks go down tomorrow? In the investments in play portfolio, this week's winner was Twilio, with a 15.26% gain on pretty much no news. Twilio had become extremely oversold and then had a really good earnings report, so people were piling into it when the market started to rally. This week's loser was Schwab, with a loss of 3.96%, on the back of an analyst report that came out and downgraded the stock once more. Schwab's just having a really hard time with it this year. In the speculation in play portfolio, it looks like natural gas may have finally bottomed, as it's this week's winner with a gain of 16.37% this week alone, although it's always worth remembering it's still down 22.87% year to date. This week's loser is also a newcomer to the portfolio, Silvergate Capital, with the ticker symbol SI, which dropped 59.73% this week, and I'll go into the reasons why later on in the video. Looking at how much each position in my investments in play portfolio make up the entire portfolio gives me a lot of information about market sentiment in a general way. Nvidia remains the biggest position in the portfolio. In fact, it's grown in size since last week as people piled into it as it rallied to a new high for the year going into the end of the week. And as you can see, speculative money is coming back into the market because the new spec basket is back in number 5. With Dutch Bros, Coinbase, Meta, Roblox, Rivian, SoFi, and Twilio all rocketing higher as that speculative money goes into those high-growth stocks. Accordingly, I do feel like the market's getting frothy again. Because there's so much speculative money going into those positions, it's kind of an indicator that we're overbought and we might be due for a more extreme pullback. Analysts I follow still think that the second half of March is going to be particularly bad, with more and more people jumping on the bandwagon that there is a credit event coming. And if that happens, we're going to see a pretty substantial sell-off in all stocks and commodities as well as the bond market. I decided to open a new speculative position in the ride-sharing company Lyft this week when it made all new lows. You may wonder why I decided to go with Lyft and not the far superior competitor Uber, and the reason for this is that this was part of the speculation in play portfolio. And I believe the risk-reward right now is actually in Lyft's case thanks to its epic sell-off over the last couple of weeks. As you can see, from its 2022 high to its all-time low, it's already sold off 48.15% in a couple of weeks alone. So this stock has become extraordinarily oversold. That being said, that doesn't mean the bottom will hold. Like I always like to say, I never trust a bottom. So even though we're looking at a low of $9.52, there are no promises that it won't go lower from here. I opened my position on March 2nd with my first buy at $9.75. And from here, my next buy target is $8.55, a price calculated using the Fibonacci method. And my next sell target is $17.59, which you can see is just under its highs from 2022. I took profits in the U.S. natural gas fund UNG this week, and this is another class of 2023. I only just opened this position on January 30th. Natural gas had become extraordinarily oversold this year, and like I said, I never trust a bottom, which was a good thing because natural gas made an all-new low at $7.14 in the last week or two. However, from that low to Friday's high, it has rallied 40%. So it was time for me to take profits. I did so on Friday the 3rd with a sale that went through at $9.83. And I'm taking small profits at this point because I believe we're going to see a larger bounce. This sale locked in 22.26% in gains on a few shares that I bought at an average price of $8.04, and it lowered my per share cost 1.71% from $8.75 to $8.60. From here, my next buy target is $7.17, slightly above UNG's all-time lows. But like I say, I have buys scheduled below that too because you can never trust that it won't go lower than it's already been. I'm going to continue trimming small profits as UNG continues to rally, with my next sale not much higher than here at $11.39, just below a past point of resistance. The riskiest position in the speculation in play portfolio is now my new position, Silvergate Capital, with the ticker symbol SI. Silvergate is a full-fledged bank, but it catered exclusively to cryptocurrency interests and companies. This week, the company announced that it would be delaying its annual report, its 10K filing, because its accountants needed more time to audit the bank. Since this is an actual bank, whenever any client hears that their bank's having financial trouble, the prudent thing to do is to withdraw all your funds, which is exactly what major clients did, including Coinbase and several other really major crypto firms. It will be extremely challenging, if not impossible, for Silvergate to survive this, so this is a binary outcome. Either the 10K comes out and Silvergate's figured out a way to survive, or it's really possible that this stock could go to zero in a hurry. Because of this, you can see that in just 2 days of trading, Silvergate dropped 64.15% to its all-time low down here, which was made on Friday at $4.85. I started my position on Thursday, March 2nd, with a first buy at $7.40, as well as a second buy at $6.80, which leaves me with a cost basis of $7.25, a reduction of 2.03% from where I started this position. However, like I said, this is now the most speculative position in the entire portfolio, so accordingly I've only allocated a tiny amount to it. In fact, as you can see, even after the 2 buys that I made on Thursday, Silvergate is only 0.7% of the entire speculation in play portfolio. And to give you an idea of how much I've managed the risk in this position, if Silvergate goes all the way to zero, I will have lost less money in Silvergate than I did in the put spreads that I bought in January and sold last week. From here, my next buy target is $4.50, slightly underneath its low at $4.85. And I'm going to be holding on for a little while, so my next sell target isn't until $22. We have to see what happens after their 10K comes out, and we see whether or not this one's just going straight to zero. After I sold the put spreads that I bought in January last Wednesday, I had a number of viewers ask me, can I go over what would have happened if I had held them over until expiration, which was this Friday, March 3rd. I sold the put spreads around 11 a.m. Eastern Time and locked in gains of 76.96%. But as I said last week, that was only 66% of the maximum profit. So in this hourly chart, we're going to take a look at where the S&P 500 went from last Wednesday to this Friday where my put spreads would have expired. As you can see, the S&P 500 actually sold off a little bit more. So if I held on a little longer, I could have gotten more profits out of this position. However, at the close of day on March 3rd, Friday, it closed at $404.60. Since that's significantly higher than my $400 put spread that I own, that means that entire trade would have gone from being up 76.96% to being an utter loss. I would have lost all the profit plus the initial capital. It would have zeroed out entirely. In the future, I'm highly unlikely to use options again. I've gotten a little bit more into using leveraged ETFs, inverse ETFs, and things like that. They offer me more time frame to work with, and that seems to be the biggest weakness that I have when it comes to options. So stay tuned, I might get both the courage and the stupidity to try and be bearish on the markets once more. You can learn more from my website, geterk.com, 100% for free. Please hit like and subscribe, and I'll see you in the next video.